I'm about to show you exactly how Australian property owners can legally avoid paying capital gains tax, potentially saving $100,000 or more. Capital gains tax on property is one of those areas where you either save a fortune or lose a fortune, depending on whether you understand how the exemptions work. As an accountant, I've seen it all. And trust me, you need to know these traps. Here's what you'll learn over the next few minutes. The 3 pathways to paying 0 CGT on property, the 6-year rule and when it actually applies, how business owners can slash CGT on commercial premises, and the 5 traps that quietly destroy these exemptions and cost you tens of thousands. This video could just be the difference between you saving hundreds of thousands of dollars on CGT and handing it over on every property you own. So let's dive in. Let's start with what most people get wrong about capital gains tax, or CGT. If you sell an investment property that's grown in value, you're facing a capital gains tax bill. Let's say you bought a property for $600,000 and sold it for $900,000. That's a $300,000 capital gain. But here's the cost of not knowing the rules. If you're on a $150,000 salary and you sell that property within 12 months, that entire $300,000 gain gets added to your assessable income. Suddenly, you're paying tax on $450,000 that year. And with a 47% marginal tax rate, you're looking at over $141,000 going straight to the ATO. But if the property was genuinely your main home, you pay 0 capital gains tax when you sell it. Complete exemption. Now, here's where most property owners miss the opportunity. What happens when you move out and start renting it to tenants? Let's say you bought a home in Brisbane in 2018 for $650,000 and you lived in it as your main residence for 1 year. Then work relocated you to Sydney in 2019. The market value when you moved out, $680,000. Normally that Brisbane property would now be considered an investment property, which means when you eventually sell it, you own capital gains tax from the time it was rented out. But here's the biggest factor that changes everything. The Australian government allows you to treat that property as your main residence for up to 6 years after you move out, even though you're renting it out and earning an income from it. This is the 6-year rule, and here's what makes it so powerful. You can rent it out, collect rental income, claim all of your tax deductions, and still pay 0 capital gains tax when you sell it, as long as you sell it within 6 years of moving out and don't nominate another property as your main residence during that period. Fast forward to 2024. You sell the Brisbane property for $950,000. You've made a $270,000 capital gain. You lived in it for 1 year, but rented it out for 5 years. But you're within that 6-year window. So the entire property is still considered your main residence. You pay 0 capital gains tax on that $270,000 gain. But what happens if you go beyond that 6 years? The exemption becomes prorated. If you rent it out for 9 years, 6 years are covered by the exemption. That leaves 3 years taxable, or 1/3 of the capital gain. And here's the part most people miss. Your capital gain is calculated from the market value on the day you first rented it, not your original purchase price. But hang on, there's still one aspect that even accountants often miss about this. You can actually reset the 6-year clock. If you move back into your property and reestablish it at your main residence, the 6-year clock resets. Let me show you how this works. You lived in your Brisbane property for 1 year. You moved out and rented it for 5 years. You're getting close to that 6-year limit. You decide to move back in for 1 year. After living in it again, you move out and rent it out again. The 6-year clock starts again. You now have another 6 years of CGT exemptions from that point forward. This means you could hold and rent the property for over a decade while still maintaining CGT relief, as long as you move back in strategically to reset the 6-year clock. There's one more pathway that a lot of business owners don't know exists. If you own a property that's used as your business premises, like an office or warehouse or commercial space, you can potentially reduce or even eliminate the capital gain when you sell it under the small business CGT concessions. But here's the catch. It only works if the structure is set up correctly from the start. Most business owners buy a commercial property in their personal name or in the wrong type of trust, and by the time they go to sell, they've locked themselves out of these concessions entirely. Here's what makes this powerful. If you qualify, you can access up to 4 concessions that stack together, potentially reducing a $500,000 capital gain down to 0. But here's the catch. Your business needs to meet specific tests, and the way you own the property affects which concessions you can access. If you own a commercial property or you're thinking about buying a business premises, the time to structure this correctly is before you buy it, not when you're ready to sell. Once the property is in the wrong structure, it's often too late to fix it without triggering CGT and stamp duty. If all that sounds great, there are still traps that destroy these exemptions, and you need to know this to stay out of hot water. Trap number 1, the 2 property problem. You can only have one primary residence at any given time. This is the mistake I see most often. Someone moves out of their first home, buys a second property and moves into it, and thinks they can claim the 6-year rule on the first property while also claiming the main residence exemption on the second. It doesn't work that way. You have to choose. You can only nominate one property for the exemption at any given time. If you have 2 properties and are trying to claim exemptions on both, you will have a problem. Trap 2 is not proving you actually live there. If you're claiming the main residence exemption, you need to prove you genuinely lived in the property. The ATO looks at this as a question of fact. If you actually live there, you should have the evidence. That means utilities in your name, your address updated with the electoral roll, your address changed with the ATO, bank statements showing that address. If you can't prove you live there, you can't claim the exemption. It's that simple. Trap 3 is forgetting to get a valuation when you moved out of your main residence and start renting it out. You need to get a property valuation done on the day you move out. That valuation becomes your cost base for CGT purposes if you go beyond the 6-year rule. I've seen people sell a property 10 years later and realize they never got a valuation done when they moved out. So now they're scrambling to reconstruct the property's value from a decade ago. And the ATO won't just accept an estimate. Get the valuation done on the day you move out. It costs a few $100s and could save you tens of thousands of dollars in tax. Okay, trap number 4 is not keeping expense records. Here's something most people don't know. If you own a property and you're not renting it out like a holiday house, all of your holding costs add to your cost base. Your cost base is what the property costs you in the first place. It's your purchase price plus all the expenses you incur to acquire it and hold it. When you sell, your capital gain is the sale price minus the cost base. So the higher your cost base, the lower your capital gain and the less tax you pay. Rates, insurance, maintenance, gardening, pool cleaning, every single expense increases your cost base, which reduces your capital gain when you sell. But you need to keep the receipts. The ATO says you can't just estimate or extrapolate. You need the actual receipts. So if you've got a property that's not your main residence and you're not renting it out, start keeping every single record now. Trap number 5, assuming you need to move back in for 12 months. There's a common misconception that if you want to reset the 6-year clock, you need to move back into the property for 12 months. That's not true. You can move back in for 1 day and reset the clock, but you do actually have to move back in. That means changing your address with the tax office, updating the electoral roll, switching utilities over, having your mail sent there. You need evidence that you genuinely moved back in. Most people wouldn't go through all that effort for just 1 day, but the point is there's no minimum time requirement. The requirement is that you actually establish it as your main residence again. The main residence exemption and the 6-year rule are the two of the most powerful tax strategies available to Australian property owners. But they only work if you structure things correctly from the start and avoid the traps along the way. If you're thinking about moving out of your house and renting it, or you've already done that and you're not sure whether you stand on CGT, the time to get advice is before you sell, not after. Once the sale goes through, your options disappear. If you can plan ahead, you can structure things in a way that keeps more of the profit in your pocket and less going to the ATO. But if you're thinking about buying a property in a family trust, you need to watch this video next. I'll see you over there.